We start by defining the three different types of money that exists. Central bank monies are at the core of the system. It's a form of digital cash that only the big banks can get hold on since they are the only ones that holds accounts at the central bank. The public can't use these monies in transactions. As we shall see, only banks use their digital cash internally. Next tier consists of banks' debts to customers. The customer's account is always the bank's debt to customer that the banks can pay in physical cash, for instance through ATM machines. Hence, this tier isn't really money. The third tier of money is physical cash. Banks can only pay back their debt to customers in the form of notes and coins. Notes and coins are also a form of central bank money, just as the digital cash at the core. Let's make an example showing how banks swaps their debt with each other in a closed system using the digital cash at the central bank. We will only use 3 big banks in this example. There might be more than 3 banks that got access to the digital cash at the central bank, but the number of banks that have access to digital cash at the central banks is small in every country. Note that the public will not be able to get to the digital cash at the central bank. Also note that the customer's accounts are the bank's debts to the customers. The debt is not money in itself. Let's say John got an account at Bank 1 and Eric got an account at Bank 2. Let's say that John wants to transfer $1,000 to Eric's account. Most people think that the transaction is direct from bank to bank. Something like this. But Eric's bank won't accept this, since the bank then would increase its debt to Eric. Eric's bank demand that John's bank simultaneously deliver $1,000 in digital cash as compensation in order to take over the debt. Note that John didn't pay any money to John. The only thing happening was a bank debt swap. John got less of his bank's debt on his account and Eric got more of his bank's debt on his account. Hence, transfers between different bank accounts isn't actually a payment system. It's more accurate to call it a bank debt swapping system. Also note that the big banks never needs to pay their debts to the customers as long as the big banks as a cartel can keep people from making withdrawals. In other words, the cashless society would mean that the banks get a total debt write-off. So it's fair to ask, why should people pay their debts to banks when banks make every effort to avoid to pay their debt to customers? So the numbers on an account is the bank's debt to the customer and nothing else. But how was this debt created? Let's study it in more details. Let's assume that John bought a house for £300,000. The bank didn't lend John any money. The only thing the bank did was simultaneously creating 2 debts. John got a £300,000 debt signing a paper. At the same time, the bank put itself into debt with the same £300,000 by increasing John's account with the same amount. So John and the bank borrowed the same money from each other simultaneously. No one borrows anything if you lend something out and lend it back at the same time. Hence, the only thing the bank created was 2 debts on the same non-existing money. The trick is to make people believe that the bank's debt, that is to say the £300,000 on John's account, is money, while John's debt to the bank is nothing else than just a debt that has to be paid, no matter what. The big banks having accounts at the central bank can create the illusion that their debt is money by swapping debt between each other, as previously shown, using electronic cash to compensate each other. People get the impression that they pay each other money through transactions between 2 accounts, but the only thing happening is that the sending customer account holds less of its bank's debt and the receiving customer get more of its bank's debt on his account.